India is a country of close-knitted families, having a lot of reasons to celebrate owing to its diversified culture, customs, and religion. Well, there are numerous occasions for exchanging gifts. And in fact, gifting each other is not only a symbol of love and affection, but also a symbol of your social status. However, many a times, gifts can also be a part of tax planning or tax avoidance and even tax evasion. Please remember that tax planning or tax avoidance is when you operate within the four corners of the law, and this is legal. Tax evasion is when you sort of go outside the four corners of the law and then start to operate. This is prohibited and you can be penalized for the same. Hi everyone, my name is Deepak and welcome to the YouTube channel of Connecting Minds. In this episode, we will discuss or talk about the tax implications on the receipt of gifts. So this is going to be a short video, and without wasting any further time, let's start understanding the background. Gift tax was firstly introduced in the year 1958 by way of the Gift Tax Act. And the sole objective of this act was to tax the donor or the person giving the gifts under certain circumstances. After nearly 40 years, this act got abolished, and therefore there was absolutely no tax on the gifts exchanged between persons. This went on for around 6 years, and in 2004, taxation of gifts were reintroduced into the Income Tax Act of 1961, wherein two major sections got amended or modified to accommodate taxation of gifts. One, of course, was a section defining income, where it said that income of a person now includes the value of gifts received, and the other section listed down the conditions under which gifts would be taxed under the fifth and the last head of income, called income from other sources. Well, first let's discuss about gift in the form of money, cash or check. The section says that for such gifts, if the aggregate value in a particular year exceeds 50,000 rupees, then the entire value would be taxable in the hands of the recipient or the person getting the cash or money. Now coming to gifts in the form of property which is movable, say paintings or jewelry. Well, under this there are two aspects. The section says that if movable property is gifted for no consideration, that's basically free of cost, then if the aggregate of the fair market value in a particular year exceeds rupees 50,000, then the entire fair market value would be taxable in the hands of the recipient. Fair market value, to put in simple words, is the value that the movable property would fetch if sold in the market today. Under the second aspect, the section says that if the movable property is gifted for an inadequate consideration, and if the aggregate value of the difference between the fair market value and the sale consideration, if that exceeds 50,000 rupees in a particular year, then the entire difference would be taxable in the hands of the recipient. To further understand this concept, let's take the help of an example. Now, let's say a painting is being sold by Mr. X to Mr. Y, wherein the fair market value or the FMV of the painting is say rupees 11 lakhs, and this is the value that the painting would fetch if sold in the open market. Now, in the first case, if Mr. X is selling the painting to Mr. Y for no consideration or free of cost, then the condition is such that if the aggregate of the fair market value exceeds rupees 50,000, then the entire fair market value would be taxable in the hands of the recipient. Now in this case, yes, obviously the fair market value of rupees 11 lakhs is exceeding the threshold limit of rupees 50,000, and the entire fair market value of rupees 11 lakhs would be taxable in the hands of Mr. Y. In the second case, let's say Mr. X is selling the painting to Mr. Y for an inadequate consideration that is almost like a gift, and say the consideration fixed by Mr. X for the painting to Mr. Y is say rupees 9 lakhs. Now the condition here is such that if the difference between the fair market value and the sale consideration of the painting exceeds rupees 50,000, then the entire difference would be taxable in the hands of the recipient. So in this case, the fair market value is rupees 11 lakhs, the sale consideration fixed is rupees 9 lakhs, the difference of 11 lakhs and 9 lakhs is rupees 2 lakhs, and since that is exceeding the threshold limit of 50,000, the entire difference of rupees 2 lakhs would be taxable in the hands of Mr. Y. Well, an important point to be noted here is the fact that movable property for the purpose of gift tax does not include personal movable property like cars, watches, mobile phones or computers. It does not include stock in trade for a particular business like raw materials or finished goods, but it very much includes shares, securities, jewelry, sculptures, drawings or any work of art. Now coming to gifts in the form of property which is immovable, say land or buildings. Here also there are two aspects. Under the first aspect, the section says that if immovable property is sold for no consideration or free of cost, and if the stamp duty value exceeds rupees 50,000 for the property, then the entire stamp duty value would be taxable in the hands of the recipient. Here the limit should be seen for every such immovable property and not for all immovable properties put together in a particular year. Under the second aspect, the section says that if the immovable property is sold for an inadequate consideration, then you need to check two conditions. The first condition is such that the difference between the stamp duty value and the consideration value should be more than 50,000 rupees. And secondly, the stamp duty value should be more than 105% of the purchase consideration or the consideration value. So if these two conditions are met, then the difference of the stamp duty value and the sale consideration would be taxable in the hands of the recipient. To understand this further, the second aspect especially, let's take the case of an example. Now let's say we have a building whose stamp duty value is rupees 32 lakhs. The sale consideration is fixed by the seller on paper as rupees 30 lakhs. And if this building is sold for an inadequate consideration, then there are two conditions that needs to be met. First condition is the fact that the difference between stamp duty value and sale consideration should be more than 50,000 rupees. So in this case, the difference as you can see is rupees 2 lakhs, that is 32 lakhs minus 30 lakhs. And since 2 lakhs is more than 50,000, the entire differential value rupees 2 lakhs would be taxable in the hands of the recipient. The second condition is such that the stamp duty value should be more than 105% of the sale consideration. So in this case, the stamp duty value is of course rupees 32 lakhs. 105% of the sale consideration comes to 31 lakh 50,000. And since 32 lakhs is more than 31 lakh 50,000, condition 2 is also met. And therefore, since these two conditions are satisfied, we can say that the differential value of rupees 2 lakhs, that is 32 lakhs minus 30 lakhs, is fully taxable in the hands of the recipient. Now let's see some exceptions. Yes, there are cases in which if you receive gifts in the form of cash, money, movable or immovable property, gift tax will not get deducted. So gifts received from one or more relatives, received on account of marriage, received under will or by way of inheritance, received in contemplation of the death of the person before he makes the will, received from a hospital, university, a local trust, and even received by a 100% Indian subsidiary company from its holding company. In all these cases, gift tax will not get deducted. As you can see on the screen, it's very important for us to further break down the term relative to understand the point of exception. So if Mr. X is the SSC or the assessable person, then his relatives would include number 1, the spouse of Mr. X, that is Mrs. X. Number 2, the brother or the sister of Mr. X. Number 3, the brother or the sister of Mrs. X. Number 4, the brother or the sister of either of the parents of Mr. X. Number 5, the linear ascendants or linear descendants, that is levels above and levels below Mr. X. Number 6, the linear ascendants and linear descendants of Mrs. X, that is levels above and levels below Mrs. X. And finally, spouses of the above mentioned persons. So therefore, Mr. X's niece nephew or Mrs. X's niece nephew or say Mrs. X's uncle aunt are not covered in the definition of relative. And therefore, any gifts received from them would very much attract gift tax. Well, I hope I was able to make things clear through this particular video. If you like the video, do show your support to us by hitting that like button. If you want to become a member of this growing channel and receive notifications on a weekly basis as and when we upload videos, please do hit the subscribe button. Also tap on the bell icon on the side to receive notifications at a faster rate. I've given the links to my previous 2 videos, one on GST and one on income tax. So if you want to check out those 2 videos, please do click on the links. I've also given my email ID in the description area below if you want to get back to me in case of requests or queries. And finally, I would love suggestions coming in for this particular video by way of comments. So I'll see you guys in the next video. Till then, it's a thank you from my side. Have a great day and stay safe.